U.S. stocks are in wait-and-see mode ahead of two inflation prints this week. And our next guest is saying that two scenarios playing out in the equity market once the post-election sugar high fades. Let's discuss that and more. We want to bring in Aadil Zaman. He is a partner at Wall Street Alliance Group. Aadil, it's great to have you here on set with us. So talk to us just about how investors should be viewing where things are today. So here we are, not too far from those record highs. We certainly have seen that momentum carry through here post-election. What are those two scenarios that investors need to keep in mind as we look ahead to the new year?
Sure. I think that what we are seeing is that once the sugar rush is over, we think that there are going to be two phases. The first phase is going to be that there's going to be a wait and watch type of an approach where businesses and consumers will want to see how the new policies turn out, how the new tax rates turn out. So they're going to scale back, which will lead to a pullback in the market, in our opinion, in the first half of 2025. And then the second phase is going to be in the second half, where we'll get the trifecta effect: low rates, low taxes, less regulation. And that's going to be pro-growth, which is going to drive up equity markets.
How much of a pullback are you anticipating?
I think up to a 10% pullback could be
a correction,
potentially a correction, yes, because we have gone up so much, and although the fundamentals are there to support it, but a pullback is definitely long overdue.
Just quickly here, there's so much buy on the dip mentality. If we were to see a pullback, what's to say that there wouldn't be enough entrance into the market to actually keep a correction from even happening?
Sure, that's definitely a possibility, and markets are expensive. If you look at the PE of S&P 500, we are trading at historically high levels, and that's not to say that we couldn't continue to trade at historically high level. It's very difficult to time it. I think some of that is going to come into play, especially with so much in money market funds, over $6 trillion. So we feel that we can't time it perfectly, but at some point we are going to get some type of a pullback in the markets.
And then talk to us a little bit more about that rebound that you briefly touched on. So you have that trifecta effect going into effect you see next year. Then what does that rebound look like? How can investors take advantage of that?
I think one of the problems that we are seeing right now is that everyone is so tech heavy right now. Even if you're investing in the S&P 500 index, you're more than 40% in tech. So I think investors really need to focus on reducing the risk in that portfolio so that once that pullback happens, they're not so heavily concentrated, and focus on other areas in the market going into 2025, which will benefit under the Trump administration. So we like financials, we like utilities, we like energy. I think those are sectors that investors should broaden their exposure to.
And so within that, which sector is the most ripe to really take on some of the share that the Mag 7 has really been able to see grow at least on a market cap basis over the course of this year as well, and within the S&P 500?
We really like the financials because, and that's playing out really well. I think there's legs to that, because we feel that the Fed is going to stay the course. With this CPI data as well, we think they're going to cut. We think that the terminal rate will go to about 3.25 to 3.5. So banks will benefit from that, greater investment banking activity. Also under Trump, we think there's going to be deregulation, which is going to help the banks. So for example, a name that we like, Goldman Sachs, they benefit from investment banking. Their assets under supervision in their wealth management and asset division is $3 trillion, more than that. So that's going to grow as the market goes higher, and that's recurring revenue for the company.
You mentioned energy too. When you see a bit of a bounce back, or what we're expecting to see here in crude, are you talking about the large oil players, or how, I guess, can investors best take advantage of that?
Sure. So we do like the large oil players because, again, sticking with that deregulation theme, I think that industry is going to benefit from that. There'll probably be more drilling projects that are going to happen. So we do like the ExxonMobils, the ConocoPhillips, which from a relative point of view are trading at relatively low valuations and also paying a very good dividend as well.
What does that mean for, and kind of more broadly looking out to some of the earnings growth expectations, what are your anticipations, especially if we were to have to move through a correction in order to see the markets hit some of the targets that the street is already setting forth for the end of 2025 here?
I think the earnings will continue to do well, especially I think the Mag 7, they will continue to perform. Mm-hmm. But like what we saw with Oracle right now, right? These are priced to perfection. So anything less than a stellar report will be led with a pullback in the market. So we think fundamentals are strong. We think the Fed is going to be accommodative. We think generally the economy is going to be in a good place, but nothing goes up in a straight line. So some type of retracement we should see.
Aadil, great to see you here this morning. Thanks so much for joining us. Aadil Zaman here on Yahoo Finance with us.